we went through 4 years of Trump, the first 4 years of Trump, which, love him, hate him, whatever the case, I couldn't care less.
It was quite exciting, very exciting.
Towards the end, it got a little exciting with COVID and everything else. Then we go and we get 4 years of Biden. And at some point during the Biden administration, something happened. Whatever.
Yeah, maybe even, that's a subject of, again, great speculation, but for sure there was a diminishment in I think the phrase is that you would ask an individual in that position is, "Are you, sir, corpus mentis?" And one might say that it was not corpus mentis at a certain point in the tenure.
Well, I would argue that, in Trump's first tenure, same thing. Towards the end of his tenure, I mean, the mental acuity was dropping like a rock. And then in Biden's term, which I don't know why we do this to ourselves as Americans, but in Biden's term, the same thing. The mental acuity was sinking faster than any of us wanted to believe or wanted to recognize. And yet, at the end of Trump's first term, the market went to new highs, and before the COVID meltdown. And then during Biden's term, the market just basically went to new highs. I mean, there was one little sell-off in 2022, but, for the most part, the market went straight to new highs.
No problem.
No problem. Trump takes over, and clearly with, a new agenda, little rejuvenation, but definitely declining mental acuity, I think, is obvious. The same thing. As soon as he takes over, market goes to new highs. And they called it like a Trump bump, whatever you want to say. And then obviously once some of his ideas, I'm being kind here, once some of his ideas were put into play, the market took a dive, and now it's come back most of the way till today. But whatever. Here's my question for you. That's that's basically the last 9 years of us talking about markets. That's from 2016 to 2025.
Mm-hmm.
We go with clearly not the two. Let's say, no way are Trump and Biden the two brightest bulbs we've ever had in the in the Oval Office.
In the pantheon of American presidencies.
Yes. I would say way down the IQ scale on both of them.
Mm-hmm.
Here's my take. But the market goes to new highs, and nothing can hurt this market. Every buy is a dip.
Every dip is a buy, but
every dip is a buy.
Speaking of corpus mentis, every buy could be a dip, but right. Every dip is a buy.
Every dip is a buy. So the question is, what can hurt this market? It's not going to be the executive branch. We've just shown that for 9 straight years, no matter who's there, it doesn't matter. It can't be the executive branch, no matter what you do. You throw idiotic tariffs in place, we go down, we come right back, 2 months later, a month later, whatever you do, as crazy as you are, as much falsehoods, lying, ridiculousness, doesn't even matter. Nothing matters. We go to new highs. The market just it's its own beast. What could derail the U.S. stock market? Could the U.S. stock market be derailed? And if it is, what could it be? I have my own thoughts on this. I'm curious to hear you. It is absolutely not going to be a person. If we were playing 20 questions right now, which not everybody knows how to play 20 questions, but if we were playing 20 questions, the answer is not a person.
So I like this question. I mean, this is a delightful, debatable topic, and so it's always very engaging. And So I've been reflecting, as I was informed of this topic prior to this discussion, I had the opportunity to reflect upon it.
Yeah, but let me just say one thing. When we pick a topic, you and I don't talk about this beforehand.
Never.
Like Dylan and I we don't discuss. So there's a top, so we can debate it. But we approve the topic, but we don't discuss it.
We're informed. Yeah,
we're informed. That's it.
But there's no prior discussion yet.
Right.
So when it comes to markets, as you know, I really look to a couple people for guidance, and just in terms of how to a framework of first principles. This is a first principles question, right? You're saying what are the if the you know what I mean. And so the first person I look to for first principles of investing is a man named Warren Buffett, who I just think is a good market philosopher. And then the second person that I look to is a man named Tom Sosnoff, who is like a Greek market philosopher in his own right, of a different, like they're like from opposite ends of the spectrum. You know, one's like a pirate, beret-laden pirate risk taker, and another is like your friendly uncle, an accountant, a billionaire accountant of some kind. But one of the things that that Buffett is most famous for is that over time the market is a scale. That in the short term the market's a voting machine, in the long term it's a scale. And the only way that the market can be consistently at all-time highs is if the underlying enterprise value of all privately held equities is increasing in value because of the growth of those businesses. There's no other way. It is impossible to have a market that is at all-time highs for a decade, we'll call it, or dancing always by the dip, always that's not a vote. That's not a speculative move. That's not, I think Apple's earnings are going to be, the iPhone's going to be whatever, or the Chinese this, or the Middle East that. That's a decade of weighing economic value and enterprise value in the largest, deepest, most robust and dynamic capital market on earth, which is the United States of America. And so when you say what can bring the market down, obviously anything can bring the market down for a day, a week, or a month. A pandemic, a bond auction, a crazy economic proposal, a war, whatever. But I think the point of this question is not to answer that, because I can give you 100 things that'll take us down for a day, a week, or a month. But I think there's a reason this is a fascinating question, is because you now have a decade of data, and you do have a pandemic, and you do have two fruitball presidents, and you do have crazy policies, and you do have war in Russia and war in the Middle East, and blah, 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 blah. And still, in the face of all that, and so when you ask what can bring the market down, the only answer to that question is what can disturb or what can take down the underlying economic value of American enterprise or multinational enterprises based in America, I guess would be probably a better way to describe it. And I think the answer is nothing. And the reason I say that is because the multinational and domestic private enterprise economy of the United States of America is so diverse, both by sector allocation, tech, healthcare, finance, entertainment, blah, 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 but also by number of participants. And so I can't think, the only thing that could take the market lower for any meaningful period of time will be a labor market catastrophe that lasts for some meaningful period of time, a population collapse of some kind, and that's really it. Because even I was just, because like a world war wouldn't do it, in my opinion. I don't think a world war would take it down. If anything, the world war would help it over time. I believe this market is as close to bulletproof as a market could possibly be. And I believe the only thing that the market is really vulnerable to for longer than even if it's 6 months, I would still consider that over a decade meaningless. And it's not just a function of the strength of the U.S. companies or the multinationals based in the U.S., or the strength of the U.S. labor market, or the relative youth and stability of the American population, and blah, blah, blah. I think it's also really one of the big bulletproof factors is that there's no alternative which we've been through down this road as well. So I think the reason I think that it is bulletproof is a function of the two reasons, all those companies and all that population and that strength of that labor market, plus the absence of an alternative.
Okay, so I'm going to give you the counterpoint. I do not agree with you. I think that is, I think it's a fair assessment of what we've seen in the last, let's say decade.
We're going to call this a decade.
Yeah, decade and a half, whatever, since 2000, because I would call the period between 2008, 2011, and 12 definitely,
Right, that defines an era. I would agree.
Yeah, that defines an era. I agree. Okay, so my argument is that in the last 15 years, you're right. There's been nothing that can take this market down, and I just tried to start with the executive branch because I think that that would be the simplest, most obvious excuse or reason, and that clearly didn't work to hurt the markets. But I do think that there's potentially something brewing. We're not there yet because we're just a couple ticks off all-time highs, so we're not there yet. But there's something brewing that we haven't seen in a long time. There is a stock market that's near all-time highs, and there are interest rates on the verge of collapse. It's not there yet. You saw a horrible auction today, bonds down 1.5. It doesn't mean there's not enough there yet. But there is something happening that we have not seen in decades. There is no doubt that there is a certain anti-invest in U.S. sentiment building up, and there is clearly not as much incentive or political support for buying U.S. treasuries, as you can see today. Remember, if you run an isolationist, if your trade policy and your essential overriding ecosystem policy is all about isolationism and U.S. first, what ends up potentially happening, the thought was, okay, we're too big to fail, so this really won't happen because people have to trade with us. But the reality of what we're seeing right now with other countries willing to let their interest rates go higher and willing to not to jump into the U.S. debt market, purposely staying away from it and possibly becoming sellers of U.S. assets, then the question is, where are all the buyers going to come from when they're filled in the U.S.? And that's what's happening right now. There were a lack of buyers because the normal participants didn't come to the game. Imagine if they threw a party and nobody came, except the immediate family. And that's what's happening. You have this very close-knit family, U.S., and all of a sudden, the U.S. has lots of friends all over, and you invite everybody to the party, but everybody's pissed at you because you're a jerk, and you charged. You know what? The party used to be free. Used to come to the party in the U.S. and everybody, you bring a dish.
No cover charge. Just pay for
no cover charge. You just bring a dish. And everybody's happy. You bring your own booze, you bring a dish, whatever it is, and it's a big, huge party. Okay, but we supply mostly everything. We supply the food. We supply.
We give you the room.
We give everything. Yeah, we give you everything. This is my analogy. Now all of a sudden we throw a big party, but this time we charge you everything. It's like charging for a wedding, but this time we're going to charge you $200 per person to show up at our party. All of a sudden, everybody goes, F you. You know what? Just fuck you guys. We're not coming. That's ridiculous. It's always been free. Now we're not coming. So nobody comes to your party. Now you're sitting around and you're looking at each other and you're like, all right, this isn't good. A, we have lots of leftover food that's going to spoil. And B, now what do? Nobody's coming to our parties anymore. So can we entertain ourselves? Or have we made this into some kind of mess that we can't really work our way out of? And it's early on. Like, we've only thrown one party. And so we don't know yet. But if you're asking me what the risk is based on all the things that, you just talked about, that I just talked about, what's the risk? The risk is that not that Joe Biden, wasn't mentally capable or wasn't all there. The risk is not that Donald Trump is Donald Trump. He could be to some people, he's a criminal. To other people, he's a hero, whatever. Who gives a crap? The risk is that it's not him. It's not Biden. It's not Trump. It's not whoever else is in the office. It's not any one person. It's that, you know what? Nobody wants to play with us anymore. Nobody wants to come over to our house. Nobody wants to come to our parties. Nobody wants to do business with us. Nobody wants to buy our bonds. Who's going to buy these? Nobody. At some point, they might say, hey, you know what? We don't even want to buy your stocks. But right now, we're still doing business and this and that. But what happens if we decide we don't want to? And so the risk to this market, for the first time in a long time, is a continuation of some of the current policies that are being implemented right now. The risk is that if we push through, let's just say as an example, a huge budget bill, and we alienate we alienate the poor, if we give tax cuts to the rich, and we blow up the deficit here, bond market crashes. Nobody backs. There's only so much liquidity you can generate into the system, and nobody else wants to jump on board. Even if they think they're buying cheap, they're like, hey, you know what? Screw them. Let them crash and burn. You know what? That's you've seen that happen before. We saw it to a limited extent in Japan for a while. We saw it to a limited extent in Russia for a while. We saw it happen in China. We saw it happen in big economies. But we've always been immune to it because everybody plays in our sandbox. Everybody always comes to our parties. And now they're like, you know what? I don't know anymore. I don't think we need you. And you're kind of seeing something today that we haven't seen for a long, long time.
So I have a few comments, if I might. One, your thinking is, rational and logical, and I think a reflection of your own underlying. Yeah, I know that you have a personal concern, not about yourself, but you have a personal concern for the enterprise that is America, for the integrity of contract law and the protection of liquidity, all this sort of standard things. You're not the only person, but you're vocal about that.
Let's hope.
Yeah, let's hope. However, I believe you are wrong.
Okay.
And not because your concerns are misplaced, but because the amount of time necessary to build, because what you're imagining is that, well, there's going to be another party or a series of smaller parties elsewhere where people don't no longer come to the America Party, even if it's the biggest and richest and most fabulous party, the Great Gatsby and all this. But instead they do their own parties, and they do smaller parties, and they go someplace else. I believe that's probably 50 years to build an alternative structure. So as much as I think there's maybe an impulsive emotional desire not to engage with America for the moment by Europe or by China or by whoever. I mean, I would think China and Europe are probably the two most alienated of the substantial economies right now, and the two with the most money and power and leverage and whatever to try to opt out. They don't have to buy. In Hong Kong or in Tokyo or in London or Milan, they can say, "Listen, I'm not buying U.S. bonds today." Where in the past, London or Paris or Milan or Frankfurt or Hong Kong or Tokyo or Shanghai, we're always in the game.
Okay, I'm listening.
I believe too. What?
Go ahead. Finish up.
I believe they don't have any place else to go. One. but even more importantly, I actually believe what happened in April, I believe the reason that the Trump administration kicked the can on the tariffs and walked the whole thing back and will walk it all back again in June or July, August, whenever, for China, I guess August, but is because of what the bond market did in April. When there was that, whatever that one night was, we all remember, somewhere in mid-April where it kind of spiraled a bit. And yet, and then immediately after that, basically, I think it was even that day or the next day, it was like, oh, 90-day pause, we'll work it out, blah, blah, blah. I guess my point is, I actually believe that me and a lot of other people believe, I'm not unique in this at all, but that the bond market proved its primacy in April and that the bond market is more powerful than anything else on earth. The U.S. bond market, I believe, is the most powerful financial institution on earth. And if the U.S. bond market calls no good on you or on your ideas, you will course correct, even if you're the president of the United States of America, and even if you're not Copus Mentis. And so for those two reasons, I believe the bond market has primacy. If anything, I kind of like the bond sell-off today because it's another little penalty for the American policymakers for doing a bad job in 2025. So they got penalized in April with the tariffs, and now they're getting penalized again with the bond auction. I mean, who knows? It's one afternoon, and I don't know the severity of, I'm not looking at a trading screen right now, so I can't see the severity of the sell-off, but whatever it is, it's a day. And so it's almost like, to use your party metaphor, my belief is, and the reason I don't think it's going to be an issue, is because it's like the bond market is like the owner of the house that you rent to throw the party. And you can party as much as you want and invite whoever you want and do anything you want, but there are certain rules about things you can't do in that house from the landlord, which is the bond market. And if you violate those rules, they'll jack up your rent in a way that will bankrupt you, literally, and jack up everybody's rent. And I think that is the most powerful corrective intervention that is more than any political movement, more than anything. Anyway, I won't go on and on and on about the bond market in terms of its power, but I actually think that the very thing that you're talking about and the evidence of, like, oh, people don't want to come to the party, that is actually one of the reasons why the market won't stay down, because the bond market's behavior, the slap on the wrist from the bond market, is the very thing that incentivizes even further correction. I would say the best thing that could happen is a few of these, in order to kind of, maybe flip some cabinet positions and, alter some of the rhetoric in favor of, a different point of view in terms of economic policy. And I do think that the Trump the Trump administration tariff regime, to steal a phrase from my friend Chris Vecchio, is not so much of an isolationist concept. It may be a misguided concept. It may be misapplied the way it was presented. There's 1,000 things you can criticize with it, but I do think at its heart, it's just a political act, just to pander. Honestly, I don't think it really has any meaning. But I do think that the underlying sort of intention of whatever the pandering component of it is a trade war to trade more. I don't actually think it's isolationist. I think it's an idea that I'm going to I'm going to accrue leverage by charging for the party, and then say, I, America, want to go to all of your parties. I want more tickets to the China party. I want more tickets to the German party. I want more tickets to
unfortunately, that's not how negotiation works. And whether or not you're trying, I think you're giving them more credit than they deserve for it. It's a misguided policy. It was ill thought out, really horribly planned, and run by a bunch of people that were incredibly incompetent. I think what Trump has discovered was that He thought he could push the Fed around, but he couldn't, because the Fed doesn't have that kind of power. The Fed can't, the Fed can't overcome the forces of money flow, which is just what moves the bond market. The Fed can't, make an auction work. That's number one. Number two, he hired a Treasury Secretary that is just absolutely brain dead. I mean, could be the dumbest person we've ever had in that role ever. And actually so unarticulate and so what feels like
I don't want to get lost on the personalities, but it's interesting because what I perceive is that the Treasury Secretary is the one kind of saving everybody's ass. I feel like it was the Commerce Secretary that got it. I felt like it was Navarro and Lutnick that walked us into it, and that Bessent is the fix-up man.
I don't think. I think that Bessent was the enabler. I think Lutnick was the mastermind. And Navarro, I don't even count Navarro. He's too stupid. I think Lutnick was the mastermind. Bessent was the enabler, and you need an enabler, and who didn't understand the role, and it doesn't matter at this point.
Sure.
It's just,
it is fair enough.
Yeah, it doesn't really matter at this point. What matters is the bonds are 110, and the notes are about to break. The notes are very close to breaking the 109 level. So
and this is going to be the biggest move in a month, the biggest move in a year. What's the size of the move right now? Size in terms of context.
Not enough to fully scare the children. Not enough to cause not enough to cause a bond market crash. We haven't seen a bond market crash. Not enough to cause that kind of move, but getting to the point where you're very close to the ledge. Like, let's just say do you ever play that game when you were kids when, each time you'd have to take a step closer to the pool and then one person eventually falls in? Sure. It's the same kind of thing here. We're all the markets are getting closer to the ledge in the bond market, and in the 2s, 5s, 10s, and 30s, they're getting closer to the ledge. They're not there yet, and so.
But don't you think these bond market moves are corrective to the misguided policies?
That's exactly what they are. They're not corrective to it. They're responsive.
If you have gajillions of dollars because you're the Chinese government, or you're the teachers' pension of California, or you're, the European Firefighters Union, or whatever, these massive, retirement institutions, and the base layer of your portfolio is risk-free yield, fixed income yields. And then you sort of spin up into some corporate and sort of add a little juice along the way. But your base layer, the foundation of your portfolio, is risk-free fixed income. And you're like, I don't know if I want to play with America because I don't know, whatever it is, right? Where are you going to go for risk-free fixed income returns? You're going to go to You're going to go to the German bond market, the Japanese bond market?
No, you're just going to go to shorter term. That's why. The yield curve's all funky right now. You're gonna do what
you just don't go 20 years on anything.
That's right. Which is exactly what's happening right now. They're just not going to the 20-year. That was the 20-year auction, that failed. The long-term auction that failed. But it impacts all the other durations. But yeah, you're going to go. You're going to go to whatever duration you feel comfortable if you had to hold it. There's not going to be any risk. There's not going to be principal risk on U.S. debt. There's just not going to be any principal risk. But there is duration risk, and so, instead of going to 20 years, you're going to go to maybe 5 years or 2 years.
5.
Yeah, whatever it is. And that's, but you got to remember, we have a lot of debt, and with certain policies, we're creating a lot more debt right now. You put major tax cuts in place, and at the same time, you upset the masses because of social service cuts. You're creating a very combustible situation, and and you're going to have to float more bonds. You're going to have to create more debt. And if you're going to float more bonds, who's going to buy these things unless you lower the rates enough to you attract people? At what price is somebody going to jump into that 30-year? Is it going to be, 6%, 7%? Are you going to get bonds down to 100? I don't know. That's my whole thing. I don't know the answer to any of these.
Your speculation in terms of so it's not that they're leaving. You're saying it's not that they're leaving the American. We'll just use this bond metaphor because it's so timely because of what's happened today. But you're not saying they're going to Germany or Japan. You're just saying that they don't want to go to the long dated bond party anymore because
what American would go to Germany or Japan to buy, to convert currency,
to buy 20-year paper,
to buy any kind of paper in Japan or any kind of paper in Germany? First of all, you get higher rates in the US, and you don't have any currency risk. It's never, and nobody's going to, especially with, you could make an argument with the dollar significantly higher, like it was before, and the yen significantly lower. Maybe there was a chance. Now, not a chance in hell. I mean, with the dollar getting killed the way it has, no paper is leaving this country. You'd be insane to do the reverse trade. So anyway, the whole point here is that the original question was, what could take down the stock market? And my argument was, well, it's not going to be who's ever sitting in the executive branch, because no matter what they do, okay, there's still some checks around.
You're saying it's the party. You're saying it's the guest list. It's the absentee guest list is the problem. Is the risk? Sorry.
Yes, I'm saying it's the policies that we're creating right now. Listen, it's the policies we created that have forced the downgrade. It's the policies we've created that have brought sellers to U.S. assets. It's the policies that are being created that are also holding different institutional investors and countries and central banks from buying our paper. So yeah, there is a direct impact. Now, is it enough right now to take the market down? The answer is no. But what if bonds go back down to 107, 108? What if we get towards 6%? I mean, I'm just saying, at what point does the amount of principal loss in the debt markets force selling in the equity markets? That's the whole question. That, to me, is the only thing that takes down U.S. equity prices. Other than that, they just drift higher.
Which then begs the derivative question, which is where I disagree with you, which is what could possibly force the bond that the bond market going towards, let's say, 6% as a boogeyman for the moment, that move in and of itself is the corrective action that prevents the market from going down for any meaningful period of time. Because even if the guests don't show up for a little while, listen, they didn't show up for COVID there's a big, we've seen lots of weeks and months where there's a face plastering down and it just comes back.
It's different.
And that
COVID's
could
different.
Happen.
No, COVID's different because COVID was, everybody just backed off because they didn't know what was happening. But there was no kind of universal. There was no movement. There was no movement away from U.S. assets. What you're seeing right now is a movement away from U.S. assets. That is a completely different animal, in my opinion. A completely different animal.
You're kind of contradicting yourself, and I'm not trying to be nitpicking or breaking your bones. Sure. But I would say you're saying it's not a movement away from U.S. assets, but it's a move away from U.S. duration.
U.S. debt assets. I'll say debt, because they're not even buying as much short-term stuff. It's just that there's been a little bit of a flight to quality. There's been the lower end of the curve is still has some appeal. But the argument here is, you're right. It's the same argument.
I don't understand why you disagree with my assertion that the very things that concern you will be naturally self-correcting because of the very bond market that you think could, like you're saying the bond market's a thing that can take us down because people don't want to play in the sandbox. Okay. But as soon as people stop playing or as soon as there's a whisper of non-attendance to the sandbox, that is the very thing that causes the corrective measures to restore the party.
Okay. I mean, if that works that way, sure. I mean,
I'm
I
just
don't
saying
know.
that's how it's
We'll
been
see.
for the last 15 years.
Yeah, well, the last 15 years we haven't had a situation that, the question is how deep does it go? And I mean, you've seen other markets and other economies that could not recover. Like, I mean, this is the same argument to a certain extent that they had in Japan, and it took them 25 years to recover. Same argument that they had in China, it took them 5 years to recover. It's the same argument that they originally made in Russia, and they haven't recovered. So, I mean, I don't know that it's that simple. All I'm saying is,
Yes, but the difference for these those examples all had the alternative of coming to America. They could say I don't need to play in those game in those worlds because I can play in New York, I can play in Chicago.
sure.
But if you're playing, but now where are you going to play? Paris?
Well, the
Hong
rest of the
Kong?
world's figuring it out. The rest of the world decided, you know what?
I agree, but I think that's a multi-decade issue. I don't think that's a short-term issue. The language is an issue. Contract
I just don't think
laws are an
people
issue.
respect. I don't think that people respect the fact that we are empowering everybody else to be an alternative to
And
us.
we're motivating them to create a bypass.
Empowering and motivating, exactly. And that to me is the risk in our market. Because remember, the whole reason for this conversation was, what's the risk? That's the risk to me, is that we're empowering and motivating. You said it perfect. We're empowering and we're motivating everybody else, so they'll need us. And then remember, if you don't need us, we end up making our own situation worse in the process.
No question about that. I mean, the entire pretext of the U.S. position is you cannot live without me, and therefore I can do whatever I want. I mean, that's the sort of abusive boyfriend mentality, right? Where it's like you have no other choices. I can treat you however I want. Is basically the American policy culture at the moment. As much as that offends me on a personal level, because I just don't want to relate to the world as as an asshole, excuse my language. But I do think that it's harder to build a bypass. I think it takes time. And I think the risk you're talking about is a risk for 20 years from now.